Hello and welcome to the Madrona Group's 15-minute forms. Today we will be talking about Form 22A Part 2. This is the financing contingency. So in Part 1, we talked about the things that the buyer needs to do in order to retain the protection of the financing contingency. And today I wanted to follow that up with what happens next. So we are already in place with our financing. We have ordered appraisal. And now what happens? First, I wanted to talk about the down payment or the buyer's closing costs. Now, in our financing contingency, we do have space before in paragraphs 1 and 2 for disclosing the loan type, as well as the down payment type. Our option number 3 in paragraph 3 is to ask the seller to contribute to the buyer's closing costs. Now, closing costs from lenders can be anywhere from 1 to 2%, sometimes even more, and that's a percentage of the purchase price. So in some situations, a buyer may find themselves unable to take on those funds and therefore wants to ask the seller for the contribution. I wanted to talk about this one specifically, though, because when we have the chance to negotiate our compensation and we want to put that towards the buyer's closing costs, we also have the right to ask the seller in this one to put it towards the closing costs. So there are basically two places that we could be asking for credits to the buyer. When you ask for a credit to the buyer through the financing contingency, it does not take any of the compensation into consideration. It only takes it from the seller's net proceeds towards the buyer's closing costs. And there are maximum limits a buyer is allowed to accept. So you'll need to talk to the lender and find out, based on the type of loan, how much the buyer can actually receive as credit towards the closing costs. Any additional that gets paid, the seller could say, I'm going to pay $100,000 of closing costs. But if the lender has a cap of 2%, then the remaining parts unpaid will just be credited back to the seller. Now, the whole point of having this financing contingency is to have that umbrella of protection for the buyer's earnest money. So the buyer has a chance to apply for financing and depend on the financing company to pull this deal together. When the financing contingency is waived, there is a waiver of retaining that earnest money based on the items that were waived. Last time in Part 1, we talked about waiving either the entire financing contingency or just the approval of financing and keeping that appraisal. So keeping that in mind, the next part of their financing contingency explains what happens during the appraisal process. So we're going to look at appraisals really quickly for today. I'm not going to be referring too much back to what it takes to keep those protections. Here's how the process works. The appraisal is done by the bank. The appraisal will come in either at value with conditions, or perhaps the appraiser will come in at a different value. Now, there's nothing wrong with an appraisal coming in above the purchase price, and we go off of the purchase price of this contract, purchase and sale agreement. But what happens if it comes in less than the purchase price? The protection of the appraisal provision will protect the buyer's earnest money in the event the appraisal comes in low. But there are areas to negotiate what happens when that appraisal comes in. So let's assume that the appraisal has come in low. Now, if this is just a low appraisal of $1,000 to $2,000, and your buyer says, you know what, I don't even want to mess with this, I'll just bring to the table the extra $1,000 to $2,000, let's move forward. Your buyer has the right to do. Now, the buyer can do so without having to waive their financing contingency, and they can keep the protection of everything in place. If the appraisal comes in low and you just can't make it happen with your buyer, step 1 is to notify the seller that the appraisal has come in low. There's a form that we use to do this. It's called the 22AN, and it's just a notice to let the seller know that the appraisal came in low. You're also going to be attaching the copy of the entire lender's appraisal with it. Now, think of this like our negotiation timelines for, say, an inspection contingency. Once we've given notice to that seller, the seller has 10 days to figure out how to work around this low appraisal. So the seller has the option of seeing if the lender would reconsider the value with an appraiser. Now, it can be done by the same appraiser or a different appraiser, but it has to be an appraiser that's approved by the lender. Oftentimes, Appraisers don't really know what to look for, and it helps to get a reappraisal done to see if maybe they missed something or didn't understand something. Appraisers are very limited as to who they can talk about and the questions they can ask. If the seller chooses to do a reconsideration of value, that is done at the seller's expense to try to get that value back up. Now, sellers, if you're considering doing a reappraisal, you're not going to be responding to the buyer within those 10 days, but rather using those 10 days to get that reappraisal done and see if that price can come back up. If you have, in fact, done the reconsideration of value and it came back at the value, then sellers can go ahead and respond to the buyer in the appraisal response form that we have, and that value will be the new value of the purchase price. Everything will have fallen into place. Option number 2, the seller could reduce the purchase price to either, this is kind of option 2 and 3 together. The seller can either reduce the purchase price to what the appraised value says, or the seller can reduce the purchase price to something in the middle where we come to an agreement. And then the third option is the seller can look at that appraisal and say, sorry, buyer, I'm not going to be doing anything about that. And then the buyer has an opportunity to decide how they want to proceed in the transaction. Remember, our first timeline for that response is 10 days. Now, once that seller responds with what they want to do based on the low appraisal notice, the buyer will have 3 days to go ahead and decide how they want to proceed in the transaction. The buyer can just choose to come to an agreement with a different purchase price. The buyer can choose to come to an agreement at the appraised value. But if the seller turns around and says, I've done a reappraisal, here's the reappraisal. If that appraisal comes back in at the contract price, then what the buyer is going to be doing is moving forward with that. If the seller says, no, I'm not going to make this work, here's my bottom line, I'm not going to do anything with the price whatsoever, the buyer does have an opportunity to walk away from that transaction and retain their earnest money. Now, if an appraisal comes back in and it comes in, say, at value, but the appraiser calls out some work orders to be done in order to actually fund that loan, then we do need to let the seller know that there are orders from the appraiser that need to be done in order to close the sale. Remember, if the appraiser calls out something like replacing a board on a step or strapping the water heater, or even something as little as installing smoke detectors, those items have to be done in order to close the loan. And if that item is in the way of you closing this loan, you need to make sure that you are asking that seller to complete those items. Now, it's not required that the seller does complete the items, but it's required that those items be complete in order for the buyer to close. So that's a great spot to come to another negotiation point and figure out, based on what those items are, if that's something your seller can take care of, would take care of, and wants to take care of. If you give notice that there are work orders and the seller chooses not to do anything about that, then it is likely that the transaction will not close. But because you've given notice that the appraiser has required these things, you are protecting your buyer's earnest money if that actually does happen. When you're working with loan types such as FHA, VA, and USDA, they have their own kind of private set of rules beyond what our contract is. Remember that when you're working with an FHA or a VA, they have what they call their amendatory clauses. What this does is it allows the buyer to not be on the hook for a property that won't appraise for the value that they claim it should be. If you're working with these companies, those clauses tend to supersede a lot of the things that are in our financing contingency. If your buyer is using FHA, USDA, or VA and chooses to waive the financing contingency or falls short on the requirements to keep that protection, then that protection may not be available for them. I hope I was able to shed a little bit of light on the rest of the Form 22A. And if you have any questions about this, please feel free to let me know.